Jørgen Knudsen has been hired to provide industry expertise to Henrik Sandel, CFA, an analyst for pension plan managing global large-cap fund internally. Sandel is concerned about one of the fund's larger holdings, auto part manufacturer Kruspa. Kruspa currently operates in 80 countries with previous year's global revenue at 5.6 billion euros. Recently, Kruspa's CFO announced plans for expansion into Bhutan, a country with a developing economy. Sandel worries that this expansion will change the company's risk profile and wonder if he should recommend a sale of a position. Sandel provides Knudsen with basic information. Kruspa's global annual free cash flow to the firm is 500 million euros and earnings are 400 million euros. Sandel estimates that cash flow will level off at 2% rate of growth. Sandel also estimates that Kruspa's after-tax free cash flow to the firm on Bhutan project for the next 3 years is respectively 48 million, 52 million, and 54.4 million euros. Kruspa recently announced a dividend of €4 per share of stock. For the initial analysis, Sandel requests that Knudsen ignore possible currency fluctuation. He expects Bhutanese plans to sell only to customers with Bhutan for the first 3 years. Knudsen is asked to evaluate Kruspa's planned financing of required 100 million euros in Sweden with 80 million euro public offerings of 10-year debt and remainder with equity offering. Question is, using the capital asset pricing model, what is Kruspa's cost of equity capital for its typical project? Cost of equity using CAPM model is risk-free rate of return plus systematic risk of stock, beta, multiplied by equity risk premium. In the information provided, risk-free rate of interest is 0.0425 and equity beta is 1.3 and equity risk premium is 0.0482. So if we calculate this, it becomes 0.1052, so 10.52%. Second question is Sandel is interested in weighted average cost of capital of Kruspa prior to its investing in Bhutan project. What is weighted average cost of capital? Weighted average cost of capital, WACC, can be calculated by weight of debt multiplied by cost of debt multiplied by 1 minus tax rate plus weight of equity multiplied by cost of equity. Weight of debt is 900 out of 3,300. Cost of debt is 0.0925 and tax rate is 0.375 and weight of equity is 2,400 out of 3,300. Multiplied by cost of equity is 0.1052. So it becomes 0.0923, so 9.23%.